Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our technical video report for Thursday, October 5th, 2023. Forgot what date it was. Anyway, the markets really didn't do a whole lot today. I think everybody's on hold until we see the job number come out tomorrow, the non-farm payroll. But again, it's something that I've explained probably 3 months ago. I started saying where everybody was starting to look for the Fed to start cutting rates and this and that. And I said that this administration is shooting themselves in the foot because they're these non-farm payroll numbers that are coming out, they're being seasonally adjusted. And typically when that happens, they get revised lower, and we're starting to see that right now. But what I'm saying about how they're shooting themselves in the foot, where instead of fluffing up these numbers, making them think that the economy is doing so well, and we need another 4 more years of this. What they pin the Fed, because the Fed's not going to start lowering rates if these non-farm payroll numbers are blowing the streets numbers out of the water. And now all of a sudden they're being revised, and you're starting to see unemployment start to tick back up again. So it's one of the things that it'll come out tomorrow. I'm almost positive. I'm willing to bet $100 to anybody that it will be revised in a couple months. It's all smoke and mirrors, this entire economy right now. And and you can tell that by when you have, I believe it's close to 75% of our population is saying that they're worse off now than they were 2 years ago. They're living paycheck to paycheck. And now we're starting to read I'm starting to read about a housing freeze, because interest rates are going up, that a lot of people, there's not going to be too many sales going on unless you're buying cash. So there's a lot of things, a lot of moving parts in this. And I didn't. I was thinking about getting long today. I was going to send out an alert, but I just really said, what's the risk reward on this? The risk is that the non-farm payroll numbers aren't seasonally adjusted, and they end up missing by a lot, and then from there we get a spike up, because everybody's going to think that the Fed's going to have to start cutting rates again. They're not going to start cutting rates anytime soon. I can promise you that. It's probably not happening until mid 2024, if not late 2024. So, we're going to have to see how they come out. It's a market moving data point that's coming out, and I don't really like to jump in front of those. It just I don't have to be in a trade every day, and I'd rather see which way it spikes. If it spikes up tomorrow, then what happens is we wait for it to come down, touch support, and when it does that, we buy it and put a stop under here. If it goes down, then what happens is we see if support levels hold, especially in this zone right here. And if they do, then we wait for them to break through resistance, and we get long and putting the stop underneath it. And that's really my game plan. So right now, if it ends up that we shoot up tomorrow, yeah, I'm going to be a little bummed out. I didn't send out at least a half a position trade alert to get long, because we came right back down to these lows right here, and then the bulls stepped in. So anyway, the hourly chart here, we do have bullish divergences, even with this move down here, and we formed another little negative momentum. It's still from here to here is a bullish divergence. We're in kind of neutral to overbought right there. And again, if the bulls can, if the numbers come out where the street likes them, I shouldn't even say if they're good or bad, because I don't know how the algorithms are going to be programmed. But let's say they're programmed the way the algorithms want, and they spike it higher. I wouldn't be surprised to see us opening all the way up at the 43.16, if not a little bit lower than that. Maybe let's just say to 4,300, and them gapping the market up. If they do, we're probably going to get another pullback that's going to come down, close the gap. And the reason why I'm saying that is because we are in the chaos and confusion phase. So when we get up there and then we reverse back down, guess what? Everybody's going to be there. Let's just say the herd is going to be doing is they're going to be shorting it because they're thinking that this was it and we're now taking out the lows. And then we're going to get the same type of situation. It may not be tomorrow, but what I'm saying is where it comes down and then it's going to spike back up again. And they're going to use all these bears as, short fuel to get the price up to the 43.61 or possibly even coming up to the 4200 to close this gap. But I think the people that are overly bearish right now, they're one sided, just like the people that were overly bullish when we were at the highs. That you got to just kind of keep a neutral stance on things and look both ways, and then from there, we're going to have let's say a trending market at some point, but right now I'm looking at this as being a big choppy mess going nowhere for the next 6 months. And personally, I love that because we're able to, trade both ways. Back when we were melting up in 2021 and stuff, and all of our indicators are just getting blown up. What I was saying was that there's no really rhyme or reason for this extreme bullish trend that we have besides the Fed. And once the Fed steps away, there's not going to be too much of too much buying interest. And right, but that was a trend back then. And then we had the big drop, and everybody just got overly bearish then, and we had the massive move up to the 4,500 level. So it's one of the things where I like this because we're able to trade both ways. And like I said, when we were trending up, I was being pinned as a perma bear, and I wasn't a perma bear. I was just saying where we were was it was unsustainable because at some point the Fed's going to have to start raising rates, and that's what happened with it. But in any case, right now, if the bulls can jump, let's go to a 15-minute chart so we can take a look at things here. This may give us a little ideas for how we're going to open. So we don't have any bullish or bearish divergences right now. Again, same pivot, 42.76. If they get above it, we have some resistance at the 4,300. And then we're coming up to the 43.16 and then up to the 43.36. So these are our upside, say, magnets. And if they come in hotter than expected or how the street doesn't like it and we head down, if the bears can get through this 42.17, we're coming down to the 41.82, and then we could come all the way back down to the 41.65. That's where I would be buyers, and that's why I wanted to move to cash here because it gives you a clear mind. If we pop up and we stay up there, then we wait for the short position. If we come down, we wait for the market to find some kind of support, go along, and then we ride it for the move up to the 43.64 or possibly even up to the 4400. So that's about all it is. I can't really go too much more into it because we have to see how the market opens tomorrow. I did make a mistake, by the way. It's the markets are not closed on Monday. Just the bond market is. For some reason, I thought it was. So everything is going to be as usual. So anyway, have a great night, and I will talk to you guys in the morning.